Hi there, Shazrin here, and I have no debts. I used to think that was good, but after learning more and more about finance, now I know that I have a really bad problem. Let me explain. I wished someone taught me earlier about this, but that's just wishful thinking. At least you won't make the same mistake I did if you watch this video until the end. So, some of you may be asking, what is debt? Debt is something, usually money, borrowed by one party from another. So for example, you have friend A and he wants $10, $10, okay? And he borrows it from friend B. So he borrows from friend B $10, $10, okay? So that's his debt, $10. And that's just basically it. You can borrow money, you can borrow stuff, assets, liabilities. There's a lot of anything that you consider borrowing from one person or one party from another can be considered debt if that person wants it back later and you have to give it back. Now, let me just explain this. Some debts are bad for you, but believe it or not, there are debts that are actually good for you. Let me explain the different types of debts. So there are good debts and there are bad debts. Let's start with the bad news. Bad debts can strain your finances. They can burden you. They can really affect your cash flow to become lesser or become negative. And they can even hold you back from investing. For example, car loans. So you borrow money from the bank to buy a car. And not only do you have a debt with interest right now, because of course, if you borrow money from a bank to buy a car, you have to pay interest. Not only will you have to pay interest to the bank along with your debt, you will also have something that depreciates in value. Because a car each year goes down in value. Let's not even say each year. Just the moment you drive your car out of the showroom, you lose some percentage of the value of that car. So originally you bought that car for 100,000. The moment you get out of that showroom, it becomes maybe 95,000. Just saying. This is just an example. And then there are also credit card debt. So basically, you use credit cards to buy stuff, and then next month you don't have the money to pay off the credit card debt. Well, next month the credit card debt not only increases because you keep borrowing money, but because the interest is added to it. So this month's debt is $1,000. Next month's debt will be 1,000 plus interest. So 1,000 maybe, let's just say 2%. So it's now $1,020. That's your debt for next month, just because you didn't pay off that debt early on. This is bad debt. It burdens you and makes you pay more and more over time. It loses money. It's not worth it in most situations. So you really should avoid these kinds of debt. But there are also good debts that can help your financial situation. For example, student loans. Now, student loans, you basically owe money from the government and such, and you're saying you're gonna pay it off after when you start working. The good thing about student loans is why they are considered good debt is because you're borrowing money so that you can get better job, a better future, a higher pay. So basically, you're borrowing money. Sure, you may have to pay some interest, maybe 1 to 2%, depending on where you're from and how much is the interest that charges you for your student loans. But if you consider the income that you'll get with that degree, with your education, you may think that your return on investment is 10% annually. So just because your interest is 1 to 2% on your debt, but you're getting a return on investment yearly of 10%, that makes you a positive of 8 to 9% annually. So you're in the green. You're safe. It's a good debt. It makes you more money over time. Other than that, mortgages. So mortgages are basically money you borrow from a bank to buy a house. So usually, for example, you borrow 200,000 from the bank to buy a house. Now, the bank usually charges an interest rate of 3.5%, 3%, let's just say 3% annually for you to buy that house. So basically you have to pay interest of, because you're borrowing 200,000, let's just write it down. 3% is basically 6,000. Now this is just an example because each banks are different. They give you different rates depending on your credit history, credit situation. I'm just giving an example. So basically you're paying the bank 6,000 each year to borrow that 200,000. But you should also note that the housing markets usually increase by 10% annually. 10% of 200,000 is 20,000. So you're borrowing 200,000, you're paying interest of 3%, but you're getting a profit of 10% because usually your house goes up by 10% each year. So your house today is 200,000. Next year it becomes 220,000 here. So you're positive because 10% minus 3% becomes 7%, which means you're making a profit of 14,000 each year by buying that house. So mortgages are considered good debts because not only are you borrowing money to buy an asset that's really good because it makes you money, but the assets profits can pay off your debt and give you positive cash flow. You're in the green. So that's another example of a good debt. But here's the catch. Some debts require you to have a credit history before you can get it. This is where my problem comes in. So basically I make more than 5,000 bucks a month. More than 5,000 a month. I am more than qualified to buy a house. But, and this is a big but, I have no debts. And because I have no debts, I have no credit history. And because I have no credit history, I cannot apply for a loan from a bank. I cannot apply from any bank a single loan because I have no credit history to borrow money. Damn it! It's frustrating. Let me explain. So basically, this is the situation. In Malaysia, the country I'm from, right here, you need a minimum of 3,500 ringgit to borrow money from the bank. But you also need a credit history. What's a credit history? Anything that you have ever borrowed money from the bank or such, student loans, mortgages, can be encountered into your credit history. Your credit history basically shows how good are you at paying off debts. And banks want to see that. They want to see if you are capable of paying off debt. If you're not, if you don't have a credit history, it's the same thing as having a bad credit history because they don't know if you can pay off the debt or not. Now, 3,500 is enough for you to buy a loan for. I make more than 5,000 each month, but I can't apply for a loan because, so this sucks. If someone who had 3,500 a month makes 3,500 a month and has credit history, this person will be well off better than me because he could buy an asset that makes money each year. But you don't have to focus much on credit history because it's complicated. It's data that banks use, so you don't actually have the data to calculate it easily. But you can use this, the debt service ratio, to calculate if you are able to apply for a loan to get good debts. The debt service ratio. DSR, debt service ratio. So the calculation is basically this. DSR equals to So this is basically the DSR. So it's the monthly commitment. The commitments are basically what you pay every month without fail. So that includes insurance, that includes loans you have applied for before. So car loans, for example, rental houses that you're paying right now for. Anything that you have to pay each month without fail, that's a monthly commitment. Plus the loan you're applying for. So that's if you're applying for a housing loan, that's say you're applying for 200,000, that's here, loan. And then the net income Net income is calculated after taxes. So, for example, let's say you have a monthly commitment of 2,000 and the loan you're applying for has a monthly payment of, nah, that's too low. I'll just put it as 1,000. Has a monthly commitment of 1,000 and your net income each month is 5,000. So basically your debt service ratio right now is 2,000, your monthly commitments, everything that you pay for, bills and such, insurance, 1,000, the loan you're applying for that you'll pay each month, and the net income after taxes, after deducting taxes and all that, this is your income, 5,000. So basically it's now right
3,000 over 5,000.
So 3 over 5. So that basically means your debt service ratio right now is 3 over 5, or in percentage it is 60%. 60%. What this number basically means is that each month of your 5,000 income, 5,000 bucks of income each month, 60% of it will be used to pay for debts, for your commitments, for your loans, and 60% is very high. If the bank sees that you have a 60% monthly commitment, it will probably not want to give you that debt, that loan, because it thinks you're too risky. Basically means it's not sure whether you can pay it back or not if something bad happens. For example, you suddenly get fired from your job or get a pay cut or the pandemic happens. A poor DSR is one of the common reasons that banks reject loans. Approximately about 40% of people get rejected from applying loans just because they have a bad DSR. A good DSR balance is about 30% or less, so 60% is twice that number, which just shows this is really bad. You have too much debt if you have a DSR ratio of more than 50%. You have to make your payments late. You only ever make minimum payments on your credit cards, because in credit cards you don't have to pay each month the balance of your credit card. You only have to pay like 5% of the balance. But that's really bad. It's really bad because it just shows that you don't have enough money to pay out that debt, and the debt will increase with interest. So that will affect your credit rating. By making payments late also, you're also affecting your credit rating, because you're showing banks that you can't pay your debt each month, which banks don't like to see. You've maxed out your credit cards. Basically, you have borrowed the total amount you can from your credit cards. This is worrying to the bank because the bank thinks you don't know how to manage your finances. You've been rejected for new lines of credit. That's also something bad, because it shows that other banks don't trust you with paying back the loan. So this bank will think, if they don't trust you, then I shouldn't trust you too, because it shows that you may not be able to apply for the loan. You don't have an emergency fund. This is also a big problem with most people nowadays. Nowadays, people don't even have 1,000 bucks in their savings account. Now, if bank sees that you don't have money in your bank accounts, why should they trust you to borrow money and saying that you can pay them back when you don't even have money in your bank account? Your bank account is at or below $0. And this is also just the same. If you don't have money right now in your bank account, what makes banks believe that you can pay it back later when you're applying for this loan? So this all affects your credit rating, your DSR. This is all a problem to you when you're applying for loans. So to improve your DSR, let's look back at the formula. So the DSR is basically commitment plus loan over net income. Basically, to improve your DSR, to make this number go down, down, and down, you need to either decrease your commitment or increase your net income. Either you make more money each month, side hustles, other extra jobs or such, or you pay off your commitments, all those debts, all those credit card debts, money that you owe to other people or other banks. Just pay them off as soon as possible, and that will, by decreasing your commitment and increasing your net income, you will decrease your DSR. Your DSR will decrease, and that's really good. I know of so many ways to do this, to decrease your commitments and to increase your net income, but I'll talk about it in another video. For now, just know this. Not all debts are bad. Sure, there are debts that make you lose money over time, like debts on cars and debts on credit cards. But there are debts that are good for you, like debts for student loans and debts for houses, because you're gonna get more money over time. Student loans, you're gonna get a better job with higher pay. Mortgages, you're gonna get a house that increases in value over time, which makes you more money even if you were to pay the interest. And if you want to apply for those good debts, if you want to get those good debts, then you must not make the same mistake as I did, and that is not having credit history. So right now, I'm still negotiating with a certain bank, to apply for a credit card. So I can have a credit history that gives me a credit rating, so I can have a good DSR and finally get a mortgage to buy a home, a good debt. But they still haven't responded. I'm still gonna take my time and work on this. That's my take. Thanks for your time.